Welcome back, everyone. We've got a brand new explainer for you today, and we're diving into a company that has been on an absolute roller coaster ride. We are talking about Corning Incorporated, ticker symbol GLW. Now, you probably know them for the glass you drop your phone on, right? But what's wild is how quietly, yet aggressively, they've transitioned into one of the most critical players in the entire global AI infrastructure build-out. It's a massive story. We're talking huge hype, grounded financial realities, and honestly, some truly wild market swings.
But real quick, before we get started, the usual disclaimer. This explainer is just for educational and informational purposes. It is not financial advice, investment recommendations, or an offer to buy or sell any securities. Obviously, all investment decisions carry risks, so definitely consult with a qualified financial professional. Past performance does not guarantee future results. Okay, let's get into it.
All right, let's dive right into our roadmap for this explainer to make sure we cover all the bases. First up, we'll look at their incredible AI transformation. Second, the earnings whiplash that shocked investors. Third, a massive geopolitical catalyst. Fourth, we'll look at their mega deals and partnerships. And finally, number 5, we'll ground ourselves by looking at valuation and risks.
So, kicking things off with Chapter 1, the AI transformation, from specialty glass to AI gigabytes. To really appreciate this, you have to look at their evolution. I mean, this is a 170-year-old material science powerhouse based in New York. Back in the 1850s, they started with specialty glass. Fast forward to the 2000s, and they absolutely dominated the world with Gorilla Glass. You know, that incredibly tough glass on millions of smartphones, plus display glass for your TVs. But looking at where we are today in 2026, they aren't just making the screen you're looking at. They've evolved into the literal optical fiber backbone that power-hungry NVIDIA GPUs absolutely rely on. Think about it. Modern AI workloads need thousands of these GPUs to talk to each other instantly. That requires unprecedented volumes of high-performance optical fiber and photonics to move all that data at crazy speeds. And Corning? Well, they're the ones supplying those critical components. And you can see this transformation perfectly right here in their revenue breakdown. It's honestly glaringly obvious. Optical communications now drives a massive 45% of their total revenue. It totally overshadows their older, stagnating legacy segments, with display sitting at just 19% and automotive at 11%. Interestingly, solar is actually a fast grower over there at 10%, but make no mistake, the lion's share of Corning's business is now directly, inextricably tied to AI connectivity. Which brings us to Chapter 2, the earnings whiplash, beating estimates but losing ground.
Let me set the scene for you. Back in July 2026, Corning dropped their Q2 financials, and on paper, it looked flawless. Literally a perfect earnings report. They announced a massive Q2 core revenue of $4.74 billion. That was up 17% year over year, beating consensus estimates by a cool $130 million. Core earnings per share also beat expectations at 78 cents, up 30%. Plus, their enterprise network segment, the part serving those hyperscale data centers, rocketed up 65%. Profit margins expanded, free cash flow was super positive at $1.42 billion, and the CEO came out projecting a 19% sales compound annual growth rate through 2030. Sounds amazing, right?
So, you've got stellar growth, massive AI momentum, all these beats. Why on earth did the stock crash? From its late June peak, Corning's stock plummeted roughly 46%. How does a company with numbers like that suddenly lose almost half its value?
Well, the devil is in the details, specifically in the nuance of their growth numbers. Notice the deceleration here. In Q1 of 2026, their optical communications growth was running hot at 36% year over year. But in Q2, it dipped down to 32%. Now look, 32% is still fantastic growth, for sure. But Wall Street saw a deceleration. Combine that with a Q3 core sales guidance midpoint of $4.95 billion, which was just a hair below the analyst estimates of $5.04 billion, and momentum traders completely panicked. They saw the slight slowdown, got spooked, and bailed. The stock plunged 16% in a single day, which kicked off that massive peak-to-trough correction.
But you know, the market, it's never static. That brings us to Chapter 3, the geopolitical catalyst and the FCC market shockwave.
Just a week after that massive plunge, the whole narrative flipped. Breaking news hit the wire that the Trump administration had drafted an FCC ban on U.S. imports of Chinese data center optical transceivers. To really grasp the scale of this, you have to look at a Chinese supplier named Zhongji Inolite. They currently hold roughly 27% of the global market share for these optical transceivers, which is the exact hardware routing data inside these AI data centers. Now, looking at this purely from a market perspective, this draft policy is a massive supply chain catalyst.
If 27% of global supply gets restricted from entering the US, well, that massive demand has to go somewhere else, right?
And the ripple effect across the broader market was instant. When this news broke on August 4th, the entire US optical sector surged overnight. The market was basically pricing in this domestic displacement in real time. Applied optoelectronics shot up 16%. Coherent was up 13%, Lumentum climbed 11%, and Corning itself popped about 8% right in pre-market trading. Investors instantly recognized that US suppliers were going to be the ones stepping up to fill that huge supply void.
What's fascinating is how perfectly this geopolitical shift aligned with moves Corning was already making. Back in May of 2026, they had announced a massive multi-year partnership with NVIDIA. The goal was to increase Corning's US-based optical connectivity manufacturing capacity by a factor of 10, including building advanced new facilities in North Carolina and Texas. NVIDIA CEO, Jensen Huang, really hit the nail on the head here. He called it a once-in-a-generation opportunity to reinvigorate American manufacturing and supply chains. So you see, this isn't just some abstract technology story. It is a very real physical manufacturing story happening right here in the US. Which leads us straight into Chapter 4, Mega Deals and Partnerships, Securing the Infrastructure Backlog.
Because here's the thing. Corning isn't just building these massive new facilities on speculation. They are locking in this new domestic capacity with some of the absolute biggest tech hyperscalers on the planet. I mean, check out this roster. We're talking a massive $6 billion anchor agreement with Meta, a multi-year supply contract with Amazon. Zio is expanding their footprint by 15,000 new route miles by 2030. And Corning is even building a dedicated new photonics platform that's expected to be a $10 billion opportunity all on its own. So what's the big takeaway here? The so what factor? These aren't just flimsy memorandums of understanding. These are concrete, risk-sharing agreements that take the whole hyped-up AI narrative and turn it into guaranteed physical data center infrastructure backlog.
And all of this locked-in infrastructure backlog is what fuels CEO Wendell Week's super aggressive springboard growth plan. The ultimate target they're shooting for, a staggering $40 billion annualized sales run rate by the end of 2030. To put that into perspective, that is nearly a 3x increase from where they are operating right now. It completely redefines the entire scale of the company.
But as incredible as that growth story sounds, we have to look at the numbers objectively. So let's turn to our final chapter, Valuation and Risks, Pricing the AI Hype.
Let's bring this back to reality and look at where the stock actually stands today. On Wall Street, the mood is largely optimistic, but there is definitely some division. If you pull analysts from S&P Global, the consensus is a buy, with an average target employing about 28% upside. You've got firms like Susquehanna, Citi, and Bank of America throwing out aggressive targets of $200 and above. Truist sees the recent pullback as a really attractive entry point at $175. But notice Morgan Stanley sitting down there at the bottom. They're playing it much safer, holding a cautious hold rating with a target of just $165.
So the crucial point here really comes down to how you view their valuation. Right now, the stock is trading at a trailing price-to-earnings ratio of roughly 66.5. Now, strict financial models like Investing Pro and GF Value, they look at that trailing metric and flag the stock as highly overvalued today. But on the flip side, bullish firms like Citi argue that you have to look forward. If you look at forward earnings estimates, shares trade at a more reasonable 40 to 45 times multiple. They believe that premium is completely justified because of that high-confidence $40 billion springboard growth path we just unpacked.
But here's the catch. To rely on forward earnings like that, execution has to be literally flawless. And we need to be crystal clear on the risks. First, what if there's an AI capital expenditure slowdown? If those hyperscalers tighten their belts, Corning's growth halts. Second, execution risk. Scaling manufacturing tenfold in just a few years is an absolute operational headache. Third, heavy customer concentration. A massive chunk of their revenue is relying on just a small handful of mega-cap tech giants. Fourth, those stagnant legacy segments, like display and automotive, could easily drag down overall margins. And finally, those expensive valuation metrics we just talked about mean perfection is basically already priced in. There is absolutely zero room for operational disappointment, which, as we saw with the Q2 whiplash, the market will severely punish.
At the end of the day, Corning has executed an incredible pivot. They've gone from making the glass on your smartphone to literally weaving the fiber optic nervous system of the global AI boom, and they've secured billions of dollars in deals along the way. But with extreme growth comes rich valuations and, obviously, high volatility. So, after seeing this entire roller coaster play out, we want to hear from you. Are you bullish or bearish on Corning's AI transformation? Drop your thoughts, keep learning, and as always, thank you so much for joining us for this explainer. We'll catch you in the next one.